Forex signals look like easy profit. Most sell you the funnel, not the edge. Here's the filter.
Buy Euro USD at 1.0850. Stop 1.0830. Target 1.0890. That's a forex signal. Looks complete. It isn't. There's a missing field, and it's the reason two subscribers can follow the exact same signal and one doubles their account while the other blows it. Forex signals are everywhere. Telegram channels with 5-figure subscriber counts, Discord rooms, broker copy trading platforms like eToro and Zulu Trade, bank research desks. The marketing version of this market is enormous. The honest version is small. So here's the working filter. How to tell the rare provider with a real edge from the dozens running marketing funnels with trade ideas as bait. First, the sources. 6 main categories, and the channel itself tells you something about the operating model. Independent paid services on Telegram or a private website. Broker copy trading. eToro, Zulu Trade, Naga, Ava Social, where you mirror a leader automatically. Free Telegram and Discord groups, which usually act as funnels into something else. Algorithmic signals from EAs. Bank and broker research, usually free for institutional clients. And MyFXBook, FXBlue, or Signal Start communities, which double as verified leaderboards. Why does the platform matter? Because cheap to spin up platforms attract cheap to vanish operators. Telegram is the dominant retail format. It's also the easiest place on earth to delete your losing trades and screenshot the winners. Now, why are the free ones free? Rarely philanthropy. The operator earns from affiliate broker referrals, a slice of your spread every time you trade, or from upselling you into a paid course, a VIP room, or a mentorship tier. Sometimes from selling your data. The signals aren't the product. You are. That's why a free channel pushes you toward one specific broker. That broker is paying them per sign up, per deposit, or per pip you trade. The signal quality doesn't have to be good. The funnel just has to convert. Paid services run on subscription fees instead, which makes the economics cleaner, but the quality range is enormous. The best are research-driven and transparent. The worst sell backtests as live performance. So how do you actually evaluate one? 6 filters that kill most bad providers. 1. A verified live track record. MyFXBook, FXBlue, or a broker native verified account. Demo accounts and Telegram screenshots are not the same thing. 2. Risk per trade disclosed. A signal without a stated risk percentage is mathematically incomplete. That missing field from the opening. This is where it surfaces. 3. Drawdown history visible. Not the equity curve high, the worst peak to trough drop over multiple years. Hidden drawdowns are the classic red flag. 4. Realistic returns. Anything advertising 10% per week or 1,000% per year is mathematically implausible to sustain. Single-digit monthly returns are what a real edge looks like. 5. A real identifiable human behind the channel. Anonymous, masked operators have no accountability if your account vanishes. 6. Reasonable price. An honest research subscription costs tens of dollars a month, not thousands. And here's the math test that proves why. $200 a month on a $5,000 account means the strategy needs to deliver 4% monthly gross return just to break even on the subscription. Before broker spreads, before swaps, before slippage. That bar is higher than most retail traders sustainably achieve. And one more thing about track records. The headline annualized return is the least useful number on the page. What actually matters, maximum drawdown, average drawdown, recovery time, Sharpe ratio over multiple years, win rate paired with average win-loss ratio, and number of trades. 50 is too small. You need hundreds before the statistics mean anything. That's the provider side. The next layer is execution, manual signal following. You get the alert, you decide, you place the trade. You control sizing. Copy trading. The leader's trades mirror onto your account automatically, size proportionally. The platform enforces baseline risk transparency. And here's the regulatory wedge most subscribers miss. The UK FCA, ESMA, and ASIC have all flagged automatic copy trading as potentially constituting investment advice or portfolio management, which means the platform has to publish consistent leader stats and apply risk controls. Pure Telegram signals fall outside that entirely. So if a scam Telegram channel disappears with your subscription, you have almost no consumer protection. A regulated copy trading platform leaves a trail. That's a real structural difference. And then there's broker compatibility, which kills more signal services than anyone admits. A signal generating 5 pip targets on a 0.2 pip raw spread account is a completely different trade on a 1. 0.5 pip markup account. Pip values change with the base currency. Symbol naming differs. Eurodollar versus Eurodollar versus Eurodollar Pro. Latency turns buy here into buy 2 pips away. A great signal at the wrong broker is no signal at all. Now the scam taxonomy. Knowing the patterns by name shortens the learning curve dramatically. The lifestyle marketer. Rented cars, hotel rooms, vague methodology, real subscription revenue from new entrants. The post-loss pivot. The channel deletes losing trades and tells anyone who took one that they managed it wrong. The pump and dump on thinly traded crypto FX pairs. The affiliate broker funnel, where signal quality doesn't matter because the operator earns per spread you generate. The fake mentor combo. Signals plus mentorship plus a VIP room at 3 escalating tiers. The recovery scam, which targets previous scam victims with promises to recover lost funds for an upfront fee. And the clone broker, a recommended firm that turns out to be a fake clone of a real regulated one, with your funds vanishing on withdrawal. The unifying feature is always the same. The operator's revenue doesn't come from the trading edge, it comes from the marketing funnel. That misalignment is why durable subscriber profitability is structurally unlikely. So here's the verdict, and the callback to that opening signal. The missing field was risk per trade. A 1% risk on a 20 pip stop is a known position size on a $5,000 account. A 10 trade losing streak at 1% risk is a 10% drawdown. Uncomfortable, but recoverable. At 5% risk, that same streak is a 50% drawdown, and the math of recovery becomes brutal. That's why 2 subscribers following the same signal end up in completely different places. One more sanity check before you subscribe to anything. Would a prop firm fund this trader? FTMO, Funded Next, the 5%ers all publish their evaluation criteria openly. Daily loss limits, drawdown caps, consistency rules. A signal trader who couldn't pass that evaluation has, by definition, no edge that institutional risk frameworks would tolerate. Most retail traders who try to find profit through signals don't succeed. The reason is rarely the signal itself. It's unrealistic risk sizing, broker spreads eating the edge, and emotional second guessing. So here's the honest use case. Read the rationale. Learn how the provider frames setups. Track your own results for 90 days against the published record. If they don't match, cancel without sunk cost reasoning. Treat the subscription as a structured learning environment with an expiry date, not a permanent capital allocation strategy. The traders who reach consistent profitability rarely do so by paying someone else for trade ideas.
Signals are a learning tool, not a profit strategy. Check the description for the complete breakdown.